Good afternoon, and thanks for joining us for today's webinar, Acquisition Rehab First Year Credits. I'm Elizabeth Harriger, Partner and Director of Affordable Housing Services here at McKonly and Asbury, and joining me today is Bette Newcomer, Director of Compliance at our affiliated company, ML Compliance Management. McKonly and Asbury is an accounting and business advisory services firm with offices in Camp Hill, Lancaster, Bloomsburg, and Philadelphia. We provide a range of services to organizations across a variety of industries, as you can see on the screen, and we encourage you to visit our website to learn more. If you've joined us on past webinars, we're happy that you're back, and thanks for joining us again. Today is the last webinar in our three-part webinar series about affordable housing topics, and we'll be talking about obtaining low-income housing tax credits on acquisition rehab deals. The previous two webinars in the series were Low-Income Housing Tax Credits 101 and Affordable Housing Audit and Financial Statement Essentials, and those are available on our website, and we encourage you to view them if you were unable to attend them live. McKonly and Asbury has been specializing in affordable housing since the late 80s, and we provide a variety of accounting services to the industry, such as annual audit and tax return preparation, 10% tests, 50% tests, development cost certifications, agreed upon procedures, and a variety of low-income housing tax credit consulting. We also provide property compliance consulting services through our affiliated company, M&L Compliance Management. M&L Compliance Management, which we also refer to as MLCM, provides services such as tenant file reviews, including acquisition rehab lease-ups, which we're going to talk about today, assistance with preparing for HUD Section 8 management occupancy reviews, assistance with correcting non-compliance issues with state and federal programs, assistance in completing annual rent summaries for your state's housing finance agency, and much more. You can learn about us and all of these services by visiting our website noted at the bottom of this slide. For those of you who are looking to obtain CPE for today's webinar, please keep in mind that there will be 4 polling questions throughout today's presentation, and you'll need to answer all 4 of those questions to qualify for the CPE. Your answers don't have to be correct, you just have to answer. You will receive your CPE certificate by email a few weeks after the webinar. So our first polling question is up now. Just simply, do you wish to receive CPE for attending today's webinar? I'm sure most people are on the webinar because they want to learn about tax credits, and there will be very few people who want to get CPE. I hear Betty laughing, I think. If you have any questions for us during today's presentation, please submit them through the built-in questions function in the webinar control panel, and we will do our best to answer them during or perhaps after the webinar. Oh gosh, I was wrong. More people need to have CPE for attending today's webinar. So, all right, Betty, with that, I will turn it over to you to get us started with the technical information.
Good afternoon, everyone. So I'm going to try to walk you through some acquisition rehab things today to give you some background on it and how to claim the credits. I generally give this presentation to property managers, so I'm going to try not to ramble off too much into the land of compliance and what we do on that end to get everything ready so that you can get your tax credits. One thing about acquisition rehab that a lot of people don't realize is for the purposes of Section 42, acquisition rehabs have 2 definitions of the term placed in service. There's actually 2 placed in service dates for the acquisition rehab project. You have the acquired or the acquisition credit because it's an acquired or existing building. The placed in service date is the date the building is acquired by the new owner, which is usually the closing date with the Housing Finance Agency. That's considered the placed in service date, and your existing building is either occupied when it's purchased or it's at least suitable for occupancy.
So for the accountants out there on the webinar, this would be the date the building starts depreciating. In an acquisition rehab deal, likely there are going to be tenants already in the building, and the date of the closing, the date of the purchase of the property is the date we start depreciating the building.
Okay, so in addition to the acquisition date, we have the rehab placed in service date. This is the date that the construction is actually complete. All the construction is done, everybody's all qualified. That will be your placed in service date for your rehab credits.
And the rehab placed in service date then would be the date the rehab expenditures start depreciating. If we were just looking at a straight 9% deal, that would be the date likely everything starts depreciating. But in these rehab deals, that is the date the rehab expenditures start depreciating. And that is also the date that starts the clock ticking for the cost certification with the State Housing Finance Agency, is that rehabilitation placed in service date.
So when we're talking about generating the tax credit, the owner's 10-year credit period must be the same for both the acquisition and rehab credits. So you're going to claim both of those credits at the same time. If the rehab is completed in the same year the building is acquired, the credit period can begin the same year. However, if the rehab is completed the year following acquisition, the credit period will begin the year rehab is completed. And I have an example of that here to show you. So let's say that the date of acquisition is February 1st, 2021. And by some miracle of all miracles, you get all your rehab completed before December 31st, 2021. If that happens and all your tenants that are living in the property have been certified as income eligible and have qualified the unit, you can actually begin generating your acquisition rehab credits as of February 1st, 2021. However, if you have acquired the building on the same date, February 1st, 2021, but the rehab isn't completed until sometime in 2022, you still have to make sure that during this time all your initial tenant certs were completed, and if necessary, safe harbor testing has been completed, and we're going to talk about that here in a couple slides. But if that has all been done, then you'll actually start taking your credits as of January 1st, 2022. You'll take your acquisition and rehab credits in the year rehab is completed.
Right. So if your acquisition is placed in service in 2021 and your rehab is not placed in service till sometime in 2022, you can go all the way back to 1/1 of 2022 to start taking those credits, which is different than on a straight 9% deal when you can only start taking credits after everything is placed in service. So it is kind of a nice little bonus. Maybe, Betty, I don't know if I'm saying that correctly, but it's a nice tweak to the rules that you can go back. You don't have to wait until the rehab is placed in service. You can start taking them in January of that year.
Right. And in a couple slides, I think they'll be able to see what the benefit is of that.
So then claiming the tax credits, an 8609 is issued for both the rehab and the acquisition credit for each building. And a building in the state's eyes is defined by a structure that has a building identification number or a BIN. So if you've got, let's say you've got 6 buildings and you have acquisition and rehab credits on those 6 buildings, you're going to get 12 8609s because you'll have one for acquisition, one for rehab for each building. So you can have a lot of 8609s for your property if you have a lot of of buildings. Like sometimes when we see townhouse developments, they each have a bin, so they each get 2 8609s. And Betty talked about the 10-year credit period a couple of slides back. This form is where the owner makes the election for the year to start that period. If you look at line 5A, which is a little small on these slides, but line 5A up in part 1 of the 8609 lists the date the building is placed in service. So there'll be a different date for the acquisition and rehab, just like Betty talked about. And then in part 2 on line 10A, the owner makes an election to start the credits in the year, either in the year the building is placed in service or the following year. So in Betty's first example, the place in service date for the acquisition 8609 would be February 1st, 2021. And the rehab placed in service would be whatever month in 2021 it was placed in service. So if the owner wants to take credits in 2021, they would select no for line 10A because it says elect to begin credit period the first year after the building is placed in service. So you would say no because you want to take the credits in 2021. Whereas in the second example, your 8609 will have in line 5A, you'll have February 1st, 2021 as your place in service date for the acquisition, but your rehab will have whatever your date is. Let's just say it's September 30th, 2022, whatever date your rehab expenditures are placed into service, and that's going to be a different year. So you're going to answer that question for 10A differently in part 2 on each 8609. Because one, the acquisition, you're deferring it to 2022. And then the rehab 8609, you are taking it in the year that it's placed in service. Because like Betty said, you have to start the credit period in the same year for both your acquisition and your rehab credits. So that's how the lease up connects to the tax form, and then numbers from here go on the owner's tax return. So polling question number 2, have you ever been through an acquisition rehab lease up before? So we'll give you a minute to answer that. Betty, how many acquisition rehabs have you seen in your career?
Oh my goodness gracious. When I first started, I didn't see very many, but due to new allocations of tax credits now, it has definitely increased. I've probably been through about maybe 7 to 10 of them now.
Okay, so you definitely qualify as an expert.
Excuse me. Well, let's not get crazy here.
And it looks like our audience here, a fair number of them have been through one. 29% is a bigger answer than what I thought.
Okay, so there's some critical factors we have to keep in mind. For the first year credit calculations, it is, I can't express this enough, it is super critical to make sure you're keeping an accurate count of the initial household qualifications to obtain credits on the unit, because you cannot obtain credit on a unit until it has been qualified by an eligible household. And during acquisition rehab and rehab, especially once you're going through rehab, people will tend to move around. You have to move them around so you can get units completed. So it's imperative that you know where that qualified household is in the building all the time. If you have a small building, that's usually not an issue. If you only have like 20 units or so, it's pretty easy. But I did an acquisition rehab of 157 units, and it was quite the challenge to keep track of all those households, especially when you're moving them around so you can get the rehab completed. So it's critical that you know where your qualified households are in your buildings at all times.
And I feel like when you're talking about the size of it, Betty, I feel like a lot of the rehabs that M&A sees to do tax returns for are on the larger side like that because we see them in tax exempt bond deals, which are typically large unit counts.
Right, and when people are going out for the new allocations in their applications, they're taking a bunch of different projects and putting them together. So they might have 5 separate projects that were separate tax credits, but now they're combining them into one big tax credit. And yeah, it can get a little wild sometimes. So, and then you also have the speed of leasing up the units. So your management team has to not only make sure they're tracking all the people, where they're at, get them qualified, but they also want to work on getting those units leased up because, like I said, you can't get credits on a unit that have not been qualified, and that happens through the lease up process. So, you know, all this has a big impact on the equity adjustment.
It does, and just to reiterate what Betty said, from an accounting perspective here, you need to make sure you're sending a good lease up list to your accountant so that they can calculate the first year credits for the tax return. And this should be the same list that is being sent to the investor, because the investor is going to review the tax return. They're going to calculate tax credits based on the lease up listing that you sent them. So they're going to expect the tax return to match the number that they've calculated. And I can't tell you how many times we get a different list than what the investor has. So then we're comparing with the investor. We're going back to the client asking, have you, like, which list is more recent, which list is correct? Investors typically want something called a qualified occupancy summary. So just be sure that you're giving the accountant the same information that goes on that summary. And then those credits that are shown on the tax return impact the amount of equity that's provided to the partnership. And like Betty said, the speed of leasing up units has a huge impact on adjustments on equity. There are real dollars on the line. The partnership agreements have downward and often upward adjuster language for delivery of an agreed upon amount of tax credits. And the lease up timing affects those adjusters. So you'll have a pro forma that you've agreed to with your investor, and it's going to say you're going to lease up X number of units every month. And that's how they calculate how many credits should be delivered to them in that first year. So that lease up timing really affects the credits and those adjusters. And earlier is better. The earlier you can lease up your units, the better.
Okay, so to get the credits, what you have to do is you have to qualify the household or qualify the resident. Your management agent will need to implement a plan to certify your existing households. So on that date of acquisition, that's the date your credits can start. So this is the date that we will go by to get your existing households qualified. Now you can actually begin verifying household eligibility for LIHTC up to 100 days prior to the date of acquisition. However, it's very important to keep in mind that closing dates are sometimes delayed and the true effective date of the TIC cannot be prior to the actual acquisition or placed in service date. I have experienced this. I have had that big project of 157 units was supposed to close in December. So the management team started getting everything ready. Well, they never closed until April 18th. They ended up having to recertify the households 3 times. And needless to say, there were some not very happy tenants in that building. So what I generally recommend is you don't start doing anything until 30 days before you think the closing date is going to be, because you have up to 120 days before the acquisition date, because the paperwork is only good for 120 days. Now, for acquisition rehab projects, the IRS allows for certification for existing households to be completed up to 120 days after the acquisition date. This is the only time in LIHTC that your verifications and everything that you need can actually be after the effective date of the tenant income certification. So if you have up to 120 days after the closing date or the placed in service date to certify your households, there is no huge big rush to get everything done super early before closing or before acquisition. You want to get started, you want to have your plan in place, and you want to be prepared so that as soon as that date is locked in and you close, you can just take off and start doing what you need to do to certify those households. And then you have, like I said, up to 120 days after the date of acquisition to qualify your households. So let's talk about your existing household. These are the households that are actually living in the units on the date of acquisition, your placed in service date. The initial tenant income certification is completed with 120 days before or after the date of acquisition. The important thing is to use the income limits that are in effect on the day of acquisition. Where this really comes in play is, let's say your date of acquisition is March 15th. So all the existing households on March 15th, that's the day we're going to make sure that their tenant income certification is effective. That's the placed in service date. Well, come along on April 1st, that's usually when the new income limits come out. If they go up, you can't use those limits for the households that are in place because you're certifying them as of March 15th. So whatever the income limits are in effect on March 15th for your existing households, the ones that are already living there, those are the income limits you must use. The effective date of the initial certification is the acquisition date for all your existing households. Even if you don't get your tenant to sign the tenant income certification, which we refer to as a TIC. So if you hear me use the terminology TIC, that's a tenant income certification. So the tenant, if they don't sign it until May, that's okay because you're still within the 120 days of March 15th. So you still get the credits as of March 15th. Okay. Now, if your income certification is not completed for an existing household within the 120-day time frame after the placed in service date and the effective date of the TIC are the limits, like I said, the effective date, I'm sorry, let me go back. If your household is not certified within the 120 days, that's required. And let's say they have to be certified by July 15th, okay? Let's say the tenant does not sign the TIC until July 31st. That's after the 120 days. They cannot get the placed in service date, the acquisition date. This household has to be treated as a new move-in, and all information in the tenant income certification must be as of July 31st, and that's the income limits that you'll use. Okay, so it's very important to get those existing households qualified, and what the IRS will go by and the HFA is the date the last adult member signs the TIC. Now, new households, even when you're going through an acquisition rehab, usually there's vacancies, and you're going to work on filling up those vacancies because, again, you want to, get the building leased up so we can generate credits. On households that are not in place, they're new households. The effective date of the initial certification is the new household's move-in date. You will use the income limits that are effective on that household's move-in date. All information must be dated 120 days prior to or as of the TIC effective move-in date. New households, you don't get that little after 120 days to get things done. When you move a household in, all the information that qualifies that household must be dated within 120 days prior to the TIC effective or move-in date. Income limits used are always the income limits effective the date of move-in. So let's get into rehab completed the year following acquisition. So Credits can be generated beginning January 1st of the year rehab is finished. So if you acquire a property in April of 2023, but the rehab is not going to be completed until sometime in 2024, you can actually start claiming credits as of January 1st for the households that are in place. All initial income certifications, however, must be dated within 120 days of when the credit period starts. So if the credit period starts on January 1st, but you moved a household in back in July, their information would not be current or within 120 days of January 1st any longer. It's now stale information. So any household that's certified prior to September 3rd of the rehab year will need to utilize the safe harbor rule. This is a great rule that helps you make sure you can get all the credits you can get on January 1st of the credit year. The IRS created this rule to allow owners to use existing tenants as tax credit qualified in the event a household was income eligible at acquisition but went over the income limit during rehab before credits were initiated. So you can have a household that moves in July and their income is only $5,000 a year, and that's what we anticipate the income to be, their income qualified. Well, here in November, they could end up getting a really well-paying job, and now they're making $90,000 a year. In Philadelphia, this happens. This happens a lot, and these people generally don't move out. You do not have to move out if you go over the income limit. We can't kick someone out because they go over the income limit. You have to meet those limits whenever you first move in, and we have what's called the next available unit rule to protect the credits. This test is unique to acquisition rehab projects. The safe harbor rule is for purposes of the next available unit rule. I'm not going to get into a whole lot of in-depth about what the next available unit rule is, but basically what that is if you have a household at recertification time that exceeds 140% of the 60% income limit, as long as you rent your next available unit to a low-income housing or low-income tenant, you do not lose your credits. If this household goes over and then someone makes a mistake and they rent the next available unit to someone who's over income, that's when you start losing credits. So looking deeper into the safe harbor rule, this test, it's a test. All we're doing is we're testing the people that have already been qualified prior to September 3rd of the year that you're going, of the previous year that you're going to take the credits. It involves a self-certification. The tenant will come into the office and they will tell you what their income is. It's a self-certification. If you certify a household on November 10th, you don't have to worry about them. They've already been certified within 120 days of January 1st. You have to worry about all those individuals that were certified prior to September 3rd during the rehab period or the acquisition period, and now you're going to take your credits the following year. What you do need to do is if you're working with a state other than Pennsylvania, you will have to check what their requirements are for safe harbor testing. A couple years ago in Pennsylvania, they would not take a self-certification. You actually had to recertify the tenant's income to make sure they were still income eligible. But since then, Pennsylvania has changed their rule and they will allow the self-certification. Like I said, if a household comes in and they say they're now over the income limit, so that you can still claim credits on that unit, you just have to make sure that your next available unit rule is being followed. So it sounds a little wonky and complicated, but once you go through it and see how easy it isn't bad, and it's very important in calculating those credits and making sure that you're being able to get all the credits you can. So as an example, sometimes it's easier to give an example of these things than to sit here and try to explain it all. The first year of the credit period for rehab is January 1st, 2020. You have a household whose income was certified on November 23rd, 2019. Testing is not required since the certification was completed within 120 days of 1/1/20. So where you know that household is good, we don't have to worry about the next available unit rule. Now let's say the household income was certified on April 12th of 2019. This household will need tested for purposes of the next available unit rule within 120 days prior to 1/1/20. So usually the safe harbor is a pretty simple thing for a manager to do. It's a lot of times you run into more problems just getting the tenants to cooperate than to do the actual paperwork. So there's
The polling question number 3. How many days prior to acquisition can you begin certifying tenants? Is it 0, you have to wait for the acquisition date? Is it 60, 120, or 240? So we'll give you a minute to think about that and put your answer in. Betty, do you see very often that properties will start certifying too early? And
yeah, it happens a lot. Unfortunately, it happens a lot because they'll get very excited, the owners, about, okay, we have a closing date. This is the date we're going to close. And as we know, then suddenly there's a document missing and it gets pushed back and it gets pushed back. Generally, I tell people that I know whenever we're going to be doing that, not to start the recertifying of the tenants more than 60 days before, because that way you're still giving yourself, because you have 120 days after the acquisition. So then you're starting 60 days before, but you still have that 120 days after. So usually that is enough time.
And it looks like our the folks here got the answer correct in most cases. So yeah, you can start certifying 120 days prior to the acquisition date. And we do have a question for the safe harbor rule. What if you have a multi-use building and the next move-in is a market rate and not a tax credit unit? Would this cause an issue?
Well, yes, it's pretty simple. You know, we'll just use the simple thing. You will have to make that market rate unit a low income unit. Then what you can do is, once you've made that a low income unit, you can always go back and make the person that's over the 140% of 60%, you can make that a market unit. It's a little more complex than that simple answer, because when you have somebody that does go over the income for the next available unit rule, when you have market units, it's the next available unit that is the same size or smaller size. So you have to really make sure you're tracking that and making sure that you are following that next available unit rule. That's actually a whole new training by itself. So, but the simple answer is, if you have a building and they're all 1-bedroom units, just make it simple, it's all 1-bedroom units, and you have 5 units that are market and you have 25 units that are low income, and someone goes over the 140%, then you're going to have to make one of those 5-bedroom market units a low income unit so that you stay in compliance. Hopefully that answered your question. So for qualifying residents in an existing LIHTC property, this is a property that is in years 16 to 30 probably of their extended use agreement, and they've already gotten credits. This is becoming more and more popular. What's happening is these buildings in the inventory of affordable housing that have been around for a while in LIHTC, HVAC units are going out, roofs need replaced, all kinds of things. And that stuff is all very expensive, and unfortunately there's usually not enough money in the replacement reserves to cover all these major capital improvements. So what the owner will do is they will reapply for a new allocation of tax credits. So if they get their new allocation, then they get to start all over for their credit period. And I'm not going to get into how the extended use agreement still remains in place, but you have a new agreement, a new IRC. The important thing is to know is when you're qualifying these households, all existing households have to still be certified to ensure they qualify under the new allocation. So let's say the new allocation, the acquisition date is, I don't know, March 1st. You're going to have to make sure that all your households met the income limits that were effective on March 1st to make sure they qualify under this new allocation. Now, some of these buildings, believe it or not, you can have residents that have been in there since the property first opened. I've seen it, especially in a senior building. Maybe they were 62 when they moved in, and now they're 80, but they've been in here all this time, and their income has changed significantly through the years. This is a really big thing in Philadelphia because housing is so hard to find. A lot of people move in and they stay there the rest of their lives. And we're talking families because affordable housing or housing in general is so hard to find in Philadelphia. So you have this household that qualified at their original move-in. Lots happened through these years, whatnot. You do their certification to see if they are now income eligible or they'll qualify the unit underneath the new allocation, and lo and behold, they're over income. They don't qualify. Well, we can't kick them out. This is where maintaining records is super, super important, because if you have their original move-in with their tenant income certification and the backup documentation showing that when they moved in, they were income eligible, you can get credits on that unit. Now, we have had properties who have not kept very good records, and they have not had that information, and they've had households that are over the income limit. They can't get credits on that unit as long as that household is in that unit, because they have to qualify either on March 1st or when they originally moved in, and you have to have that backup documentation. Now, if you did full annual recertifications, which I know for a lot of you, you probably don't know what I'm talking about, but every year we do a recertification. It's an annual recertification, and we have two types. You can do, it's called an alternate certification or a self-certification, and you don't have to verify the income if your property is allowed to do that. Or we have the full annual recertification where we third-party verify all income and assets. The last full annual recertification or move-in, if they were income qualified and you have that paperwork to back it up and they're now over income, they can stay there. You just need to follow the next available unit rule. If you don't have that information and they're over income, it can get dicey. Just as an example, yes, we have had this happen. I've had two different circumstances. One of them, the household wouldn't move. You can't evict them because you got a new allocation and they're over income because they were there when the property was placed in service or acquired. In one instance, we had to take that unit out of the applicable fraction and the eligible basis, and we condoed it. In the other instance, and this is usually what happens, you give incentives to the person to move out. Generally, the owner will offer to pay all their moving costs to help them find a place, to pay their rent for a year, to give them a lump sum amount of money to move out. I know that sounds crazy, and you're probably thinking, oh my goodness, that could cost a lot of money. Well, you're going to lose more money by losing out on those tax credits than by encouraging your tenant who's over income to move. So just some food for thought. So like I said, a unit has to be qualified in order to earn tax credits. Therefore, it's imperative that a good tracking system is set up during rehab to follow the flow of the first year of tax credits. So I'm going to show you how I track this. It doesn't have to be anything fancy. You might have certain investors that have fancier ways of doing this, but when I'm asked to track it for my client, I make it simple. There's no sense making things more complicated than they need to be. So I'm going to show you some different examples of how I do this. All these examples are assuming January as the month the property was placed in service, and the acquisition and rehab credits are all completed in the same year. I just wanted to make this simple for the training. I wish they were all this simple as what my example is. They're usually not, but this will give you an idea of how important it is to track our units. So when you look at my little chart here, you can see I have people's names. NQ stands for non-qualified. That means when you see an NQ there, the unit is not qualified to collect or claim credits. QV is a qualified vacancy. That means the unit's vacant, but the household before qualified the unit, so it's a qualified vacancy, and you can claim credits on a qualified vacancy. So let's look at unit number 101. Excuse me for 1 second. I'm sorry. So unit 101 is occupied at acquisition. It's determined that the household, we'll call her Amy, she was qualified within 120 days of acquisition. But she moves out in June, and the owner says, okay, this unit's vacant, we're going to start rehabilitating it immediately, and we finish the rehab in August. So because the household, and you cannot claim credits on a unit that cannot be occupied. So when a unit is down for any reason and cannot be occupied, and I'm not talking normal turnover that takes, 5 to 7 days to get it back in. I'm talking major repairs, there's busted pipes, or you're doing a rehab or something, but it's not qualified for occupancy, then you can't claim credits on that unit. So in August, all the rehab is completed. Well, the unit is now available for occupancy. Since Amy was a qualified tenant, she qualified the unit, we can start picking up the credits again when the unit is back online. So the owner can include the unit in the applicable fraction from January to May because it was occupied by a qualified household, and it may be counted in August to December as a vacant qualified unit as long as the owner satisfies the requirements of the next available unit rule. The reason, like I said, it can't be qualified in June and July is because it was undergoing rehab and was not available for occupancy. So on my little chart here shows unit 101, Amy. So I always put the tenants, either their last name or, you can use a coding. I always just use the last name or their first name because it helps me relate to it as a person or a household actually being in there. But they were January through May, it was a qualified unit, household was qualified. Wasn't available for occupancy in June and July, so we can't get credits in those months, but it's a qualified vacancy from August to December. So units 102 to 106, they're all occupied at acquisition. However, it was determined that the households were all over the income limit. Non-qualifying households all moved out in February and March. All I can tell you is if they moved out that quickly, the owner offered them something to get them moving along. But they're out, so after each household moved out, the owner immediately began rehabilitating the vacant units. The owner finished rehabilitating them in July. So the rehabilitated units 102, 103, 104, and 105 were rented to income qualified families in August. That's good old Beth, Kurt, Doug, and Eve. They were qualified. We moved them in August. And during August, the existing income qualified tenant in unit 107 transferred to 106. So Flo, who lived in 107, maybe for some reason she needed to transfer for, it could be a ton of reasons why she transferred, but she transferred to 106. When a household transfers from one unit to another, they take their qualification with them, but that unit that they left then loses the qualification. And we'll talk about that here in a second. But in this scenario, the owner can include units 102 to 106 in the applicable fraction for August through December. So this is how it looks like. January through July, not qualified, can't get any credits. However, August through December, they all have qualified households in them now, and we can claim credits. Let's look at 107. Flo was income qualified within the time frame required, but during August, she transferred to unit 106, which was vacant and never a qualified unit. So what happens when someone transfers into a unit? When you qualify a unit, a household can only qualify one unit at a time. So she can't qualify 107 for the whole year because she transferred in the same building into 106. So she brought her qualification with her to 106, and 107 now becomes a non-qualified unit because it doesn't have a qualified household. So unit 107 is rehabilitated during August and September. In October, the household from unit 108, he transfers to 107. So 107 can be included in the applicable fraction for January through July and October through December. So when you look at here, 107, there's good old Flo. She was in there until July. And like I said, for whatever reason, she transferred to 106. So that qualification automatically went to 106. So 106 will now claim those credits from August to December. And 107, using Flo's qualification, will qualify from January to July with Flo. It is rehabbed in August and September, can't claim any credits because it can't be occupied. But then Gary moves in and he's income qualified in October, so you get the credits from October through December. So unit 108, it was vacant in acquisition. But Gary, brand new tenant, he moves into the unit in March and is income certified before moving. So Gary qualifies unit 108, 108, but he transfers from 108 to 107 in October and takes the status of the previous unit with him to the new unit. Unit 108 is rehabbed in October and November, so the unit can't be counted in the applicable fraction during these months. If the unit is not occupiable, it cannot be counted in the credit. So a new household, Hal, he's income qualified and moves into 108 in December. So this unit, 108, can be counted in the applicable fraction through September and in December. So let's look at that. So 108, no, it was vacant acquisition. Nobody lived there in January and February, not a qualified unit. Gary is qualified and moves in March. So he lives in there the whole way through September. I'm sorry, excuse me. So you can claim credits during those months. Well, now Gary, he transfers up to 107 for whatever reason. So he takes that qualification with him to 107. They end up rehabbing the unit in October and November, not occupiable, can't claim credits, but we qualify Hal in December and move him in so we can get credits in December. So this unit can claim credits from March to September and for December. Units 109 and 110, they were occupied at acquisition. So household Izzy and household Jan were income qualified within 120 days of the acquisition. To expedite completion of the rehab, because we're getting close to the end and the owner's like, I can get this done, I can get my acquisition and rehab credits all in the same year, I want to get it done. So they want to expedite this. So what they do is they take these two households and they move them off-site. They either put them in a hotel or generally that's what they do. They'll put them in a hotel with a little kitchen. It's called relocation. They'll put them in there until their unit is ready. So they started the rehab, they got it all done, and both households moved back into their original units in October. So these units may be included in the applicable fraction for January through August and October through December. So as you can see, they were qualified. So we got credits the whole way from January to August. And then September, we rushed through. We want to get this rehab done. We want to get all our credits by the end of the year. So they can also get credits because they moved back in October and October through December. So when you look down the December column, on December 31st, all these people lived here. Now, nobody lived in the qualified vacant 101, but because it was a qualified vacant, because Amy had qualified it way back in January, we can get tax credits for all these units at the end of the year. The important thing, a lot of people will say, well, why didn't they lease that 101 up? Well, they may have not had a tenant for it. And when you have a unit that has never been qualified, that's called an empty unit. We always want to fill our empty units before our qualified vacant, if possible. Because once you get the credit on it, even though it's a qualified vacant, if you have an empty unit, you're going to get nothing for it. If you have a qualified vacant unit, you can claim credits for it. Okay, that's the end of my little presentation. My little kitty says hi to you and have a nice day. But don't leave yet, because we still have another polling question, and Elizabeth has a couple things to go over with you. Thank you very much for attending. I hope I answered some of your questions, and I hope you have a great evening.
Thank you, Betty. That was very informative. And, you know, I was sitting there thinking, you're talking about relocation, and on the accounting side, on the cost certification side, we see relocation expenses. So it's interesting to see it in another part, in another area of LIHTC. We actually are seeing the tenants moving, and you know, you're talking a little bit about something that we account for a cost for.
Well, I'm glad I could show it to you in another light.
So our last polling question of the day, Mr. B, a qualified tenant, moves from unit 101 to unit 102 on October 15th. Which unit may claim credits for the month of October? Is it unit 101, unit 102, both, or neither? So you have to put on your thinking caps here and figure out which unit could get credits for October, or which units, or neither units. So we'll give you about a minute here to think about this and to select your answer. So equally split, it's pretty equally split there between the first three answers. So Mr. B moves from unit 101 to 102 on October 15th. Which unit may claim credits? It is unit 102, because it is the unit that Mr. B qualifies on the last day of the month. So it looks like the majority of people did get it correct. Our contact information is here. We would be happy to answer any additional questions that you have. So feel free to reach out to either one of us. And we want to thank you for joining us for today's webinar. And there will be a recording of today's presentation posted on our website and social media sites in a few days. And for those of you who requested CPE and answered the polling questions, those CPE certificates will be sent out within the next few weeks. We do have some upcoming events. If you need some additional CPE, we have a state and local tax webinar on August 15th. We have an ethics webinar on October 29th, and that discussion will center around creating a culture of ethical behavior. So whether you need CPE credits or you're just interested in some ideas for creating a culture of ethical behavior, please feel free to sign up and join us. And we are very excited to be hosting AJ Johnson live on November 7th in Camp Hill. So keep an eye out on our website and blog for additional information about topics and when registration opens. But just, you might want to save the date now, November 7th with AJ Johnson. So thank you again for joining us, and enjoy the rest of your afternoon.